Why are some advisors so against putting money into insurance for long-term financial goals? In this episode, and by the end of it, you will understand the primary reasons why advisors talk down IUL, one of my favorite financial vehicles, until they finally understand it, if they ever do. Then they usually become incredible proponents of something they used to poo-poo. You'll understand why. So I'm Doug Andrew, and I've been doing this. What's this? Optimizing assets, minimizing taxes for clients for more than 48 years. And if you've watched very many of my other educational videos, I'm very passionate about helping people optimize assets, minimize tax by using IUL, Indexed Universal Life Insurance Contracts, that allows people to participate or earn money, really good rates of return when the market goes up, which 70% of the years it does, but not lose when the market goes down. And there's some decades like 2000 to 2010 where there were 5 down years, and none of our clients lost money in those 5 down years. They may not have made very much, but they didn't lose. But they made money when the market was up. And that's why for retirement, you're able to protect your money from losses, but participate with upside gains. And that gives you average rates of return between 6 to 10% or even higher, totally tax-free. So a lot of times when I begin to introduce people to this concept of max-funded IUL, they will go, well, how come I've never heard of this before? Or else they'll start checking it out and they'll start asking some of their family or even other advisors. And then the advisors go, what? That's the stupidest thing I've ever heard of. I've never seen an insurance policy perform well. And so people get, cold feet. I would too if somebody reacted like that. And what's so funny is sometimes when they say that, I'll go, well, we'll ask them where they put their money. And a lot of times, people say, what? I've never heard of a policy that does that. Oh, really? Well, where do you put your money? We don't have any money. But I go, oh, really? So you're asking people, okay, the blind leading the blind, how to achieve financial independence. But some people come back and say, well, I asked an advisor. And I said, well, what do they do? What do they specialize in? Well, they're one of those asset managers. They take money and they diversify it into mutual funds and so forth. And I go, okay, do you want me to be honest or gentle? Now, most people say, I want you to be honest with me. I say, okay, now, I'm not trying to tear down. I've never been a believer of trying to tear down other advisors to build myself up. There are advisors that do that. Believe me, okay? No, I'm saying, well, they just don't know what they don't know, because you can't be aware of something you're not aware of. And actually, it's a lot of times not their fault. Now, I think they should be looking and studying things. Many times they're not proactive. But here's one of the biggest reasons. Most advisors out there in America and even the world, they get their securities license, okay? And it might be a series 6 or 7 or 24 or 63 or what have you. I used to have the equivalent of all of those under what is called a series 1. I could sell any stock, bond, mutual fund, or whatever, and my clients were never happier than when I got them out of the market beginning in 1980 and I started putting it into Universal Life and then Indexed Universal Life. They were never happier. Their average rates of return doubled and even tripled tax-free. Because in the market, even if you averaged 12%, you're only netting 8 after tax in a tax-deferred IRA or 401k at the end of the day. But most people aren't earning 12% of the market. They'll always tout, well, look at these big years, but if you look at real stock market history, Dalbar studies the stock market history and investor behavior, and they say the average person with money in the stock market, if they bought and held, they left their money alone, they didn't get involved emotionally, should average 9.14% over a 20-year period. But that's before tax. If you're 9, you're only netting 6. But they said, sadly, most people are not earning 9.14, they're earning 3.49. Why? Because they're buying and selling at the wrong times. In other words, when the market starts to go down 10, 15, 20, 25, 30%, it doesn't matter. Most people panic and they go, enough already. I want out. I got to cut my losses. They sell low. And then they wait, and then buy high. Unfortunately, the average return is only about 3.5%, which is pretty pathetic. That is the actual statistics from Dalbar. Now, let's give them the benefit, and let's say you earn 9 and netted 6. The problem is most advisors make their money how? By turning your portfolio over, turning your money. Most advisors make more money if they constantly turn over your portfolio. Okay, time to sell these stocks and buy these. Let's move over here. Let's transfer from this mutual fund over to here and so forth in the sake of, diversification. Or the market's going to go down, so let's sell and put it over here. And every time they do that, they get new commissions. And sometimes they go, well, we're fiduciaries. We look out for your best interest, and we're only going to charge you 1% of whatever your portfolio is every year. Now, that's whether you made money or not. They get to take 1%. So if you have $1 million accumulated with them, they get 10 grand whether they made you money or not that year. And sometimes they think that is the best way to go, 1%. Well, okay. If you started out with $500,000 and if they really did earn you a rate of return, like I've averaged my clients of 9.6%. Let's say they did that. And the $500,000 doubles to $1 million in 7.5 years, because that's how often it will double. And then $1 million doubles to 2 in another 7.5, and 2 doubles to 4 in another 7.5, and $4 million doubles to $8 million at the end of 30 years. If they charged you 1% every year as that's growing, you would have paid them just under $1 million in commissions. And they say that's the best way to go. Whereas with IUL, they say, IUL, that's expensive. That guy is just making a bunch of commission on you. Oh, really? Yeah, we're fee-based. They make a commission. Do you know the average commission on an IUL policy where somebody puts in $500,000 might be $20,000 during the first 1 to 5 years? One time, $20,000. Let's say it's $30,000. If you were going to be buying a $500,000 house from a realtor and the realtor said, hey, you can pay me 6%, $30,000 when I sell your house or buy you a house, find you a house, you can pay a realtor's fee of 6% one time. Or you can pay me 1% of whatever that house is worth every year for the next 30 years. What would you choose? Well, yeah, you would choose the one time up front. See, when somebody gets an IUL policy, the agent only makes a commission on the new money that went in at the very beginning. They don't keep making money off of the money you're making. Asset managers, they charge you 1%. If that realtor charged you 1% and your home doubled in value every 7.5 years, they would end up making $1 million. Anybody with any brains knows it's way cheaper just to pay a one-time fee instead of an ongoing fee, because that adds up. Does that make sense? But see, a lot of asset managers, they point out, oh, we only charge you 1%. They're charging you 5 or 6. We're cheaper. Not in the long run. They make their money by keeping your money going, whether they make money or not. Sometimes they think insurance should only be used to manage risk. You should only buy life insurance in the event that you die for death benefit. You should never use life insurance as an investment. I go, really? Well, yeah, because a lot of times they'll say, well, it's not an investment. Doug Andrew says it's not an investment. That's right. See, an investment in the Internal Revenue Code is defined as a place where you put money that eventually you're going to pay taxes on, sooner or later, even in a tax-deferred IRA or 401k. I don't want to pay tax on it ever. So it's not an investment. In fact, the IRS says you don't want it to go over to the investment section of the code. You want it to stay under the tax-free sections of the code, 72E, 7702, and 101A. Investments are usually volatile. You can lose money some years and make money other years. I don't want to lose during the down years, but I want to make money during the up years. I don't want an investment. But see, advisors sometimes say, oh, well, Doug Andrew even says it's not an investment. But see, it's so interesting how people twist things, and that's why a lot of advisors will downplay or say, oh, no, you should never buy insurance as an investment. And then I go, I agree, because it's not. It's way better than one of those. And they go, what? Advisors make money turning over your portfolios. They usually have not checked out IUL. But you can't believe how many times even some of my biggest critics have finally come. I remember one of the top annuity salespersons, variable annuity, that's money in the market. He came to one of my 3-day training events. He was skeptical. He used to be on national news. He was one of the gurus on NBC, on the Today Show. And he sat there, and about a day and a half in, he went, I have been advising my clients wrong for 20 years. I go, okay, don't beat yourself up. Now that you know better, sort of like good, better, best. You were doing something that was maybe better than other things. Now you know it wasn't the best. But do you want to go out and tell your clients before somebody else does? Yes. And all of a sudden, he became one of the nation's biggest proponents of max-funded IUL insurance contracts. Whereas before he went, wow, why would you ever do that? Why would you pay for insurance if you don't need it? Just put your money in an insurance company in an annuity and then you can put it out in the market. When he learned about indexed IUL, he went, oh my heavens, I didn't know what I didn't know. And he totally changed. Normally, if an advisor humbles themselves enough to actually admit they don't know what they don't know and to be open-minded, and they come and they learn, they usually go, oh my heavens. I've done this with CPAs and tax attorneys for years. So they do a 180-degree turnaround and they begin to be a proponent of something that they used to downplay. They used to say, what? What are you thinking putting money into one of those? And then all of a sudden they see actual history. They are the very ones that sometimes say, I've never seen an insurance policy earn more than 2 or 3%. Really? And then we show them hundreds of statements of our clients who have earned 16%, 25%, 61%, 153%. See this statement? This isn't fabricated. This is real. And they go, well, I've never seen one do that. Well, it's because you've never taken the time to study and check into it thoroughly to see one done correctly. So hopefully you'll understand that there's a lot of reasons, and you can study them in the book. In here, there are different reasons why sometimes advisors will downplay it or say, well, I don't think it's the best way to go. I think you ought to maybe diversify a little bit, but I think 40 to 60% of your money ought to be totally tax-free. And I know of nothing better than a max-funded IUL, which I call a laser fund, that can do that for you. So make sure to post a comment as you get educated here. Share it with others who will get insights. But if you haven't claimed your free copy of this book, do so right now. Go to laserfund.com. You contribute a nominal amount towards the shipping and handling. I cover the rest of that cost. I pay for the book. I'll fire out a copy to you. It's 300 pages of charts and graphs. But when you're in there, you have the opportunity to set up an appointment if you want with an IUL specialist that I've sort of trained and approved. They've had to pass a proficiency exam of over 150 questions in order for me to trust them, and then they have to continue with education to make sure they're doing it correctly. So this is about you and your brighter future. So get your free copy, study it, and then meet with somebody who understands how to do it right.